Last week we saw some strange things in the stock market, but this week we have the Federal Reserve Jackson Hole Symposium taking place, and that's probably going to be a market mover. A lot of investors are really focused on Powell's speech this week coming from that symposium. We'll talk a little bit about that later on, but let's take a look at some of the quirky things that happened last week. First of all, we saw the United Healthcare perform really well last week. In fact, in August, it's actually been doing quite well. This graph shows United Healthcare here had its biggest one-day jump since 2008. So what's going on? United Healthcare has been absolutely beaten up over the last number of months. And we're seeing hedge funds move into this territory. And what caused this big jump? We saw Berkshire Hathaway declare that it's actually taken a position in United Healthcare, and we saw that stock jump. Okay, this is a strange one. We saw the Trump administration make an announcement that it was considering taking a position in Intel. Intel jumped by 7%. I'm not sure what the justification is for the Trump administration to take a position in Intel. It's not a good idea typically when governments pick winners and losers with taxpayer money. A lot of it becomes very inefficient, et cetera, it reduces competition. But the announcement was made. There are consequences to the government picking winners and losers with taxpayer money. The result was that we did see AMD head down by 14% on the day on Thursday. If we look at the economic reports last week that came out, we saw the CPI numbers come out. We're going to talk a little bit about that. We also saw the PPI numbers come out. So we saw two sets of inflation numbers come out last week. The markets actually liked what they saw. I'm not sure quite why, because we'll take a quick look at those numbers. To start with, we saw the CPI number, headline inflation, come in at 2.7% versus an expected 2.8%. And investors loved that. They cheered the news and the stock market went higher. But it's not quite that easy, because if you take a look here, if you take a look at this blue line here, that's the core rate. And the core rate came in at 3.1%. So we're still well above the target of 2%, both for the CPI headline inflation rate and the core rate, which removes food and energy. And the Federal Reserve focuses more on the core rate than they do on the headline number. So we are seeing a little bit of an uptick in the core rate and still above 3%. This graph shows the core rate in white for CPI, and we can see here that the actual rate came in at 3.1%. The survey was for 3%, so we saw the core rate move higher, or come in higher than expected. So headline rate, a little bit lower, core rate, a little bit higher. Federal Reserve pays more attention to the core rate. So this is interesting. And we also saw Supercore, which is in purple here, come in at 3.2%. It does look like these are starting to move higher. It's hard to argue that we're still seeing a trend lower for inflation at this point. Last week we did see the PPI numbers come out. That's the production price index showing the inflation for producers. And this is less food and energy once again. We saw the PPI number come in at 3.7% versus an expected 3%. That's a huge upside for the actual number, so much higher than expected. We can see that here in the graph. First of all, we have seen PPI head lower for quite some time, but look at what's happening in 2024. We're seeing these numbers head higher. Yeah, they did come down a bit, but look at this blue number, this blue line here versus the purple, which is the expected. That's the beat with a much higher actual versus expected. So it looks like we're starting to see a tick higher, and overall the trend has been higher for the PPI numbers. Now, PPI is not CPI, I get that, but when you see large upticks in PPI, that does indicate that we could see that transfer into CPI down the road. This graph shows the core PPI, the core CPI, and the core PCE, which came out at the end of July. You can see here we have seen this rise up into June 2022, which was the peak at 9.1% for the CPI. We did see that trend lower, there's no question, but we're starting to see a movement at least sideways and perhaps higher overall. Okay, so let's take a look at the results last week for the market. First of all, we saw the S&P 500 move higher by 0.9%. Interesting, the healthcare sector, 4.6%. That's largely the result of United Healthcare driving this. And if we take a look, the communication services was up 3.6%, consumer discretionary 2.4%. I find this interesting with the fact that both of these are growth sectors. The next growth sector is the technology sector, and it was actually down marginally last week. That's quite a big discrepancy. We'll have to see what happens this week. Materials was stronger last week as well. Consumer staples down 0.6%, and utilities. So the healthcare sector did well as a defensive, largely because of United Healthcare, but the other two defensive sectors did not do well. Here we are in the markets as comparison here. We've got the TSX was up 0.5% last week. Small caps up 3.1%. Small caps have been underperforming the large caps for so long, and there's a question about whether, well, maybe we're coming to an inflection point because they're just getting so cheap relative to large caps. From a seasonal basis, in the last part of August, heading into September, we can see the small caps actually pick up here a little bit. And last week we saw exactly that, up 3.1%. China was up 2.6%. Emerging markets was up as well. So most markets we saw here, at least here, perform the S&P 500. We're seeing some of the other outside markets outside of the US actually perform well here at this point. If we take a look at some of the other subsectors in the market, here we did see gold down 1.8% last week. It's been pulling back here a little bit, still in its consolidation band, hasn't broken down. It's been consolidating for a few months here. Gold miners were up marginally last week. If we take a look all the way out to here, home builders up 4.8%. Now that's largely a reflexive action to the fact that the Federal Reserve might be cutting rates, which would help home buyers as well. This week we do see some home builders reports, so it's going to be interesting. Uranium last week was down 2.4%. Interesting, the retail, 3.5%. The retail numbers last week weren't that strong around expectations. We do see some retail companies reporting this week. So I call this Retail Week coming up because the number of retail companies are reporting. So it's going to be interesting to see if the companies live up to this performance that we saw last week in the sector. In Canada, on Tuesday, we do see the CPI numbers coming out, the inflation rate numbers coming out on a year-over-year basis. The prior month was 1.9%. It's expected to come in at 1.8%. So a tick lower. Now, the CPI core number, so removing food and energy and taking the median value, the prior month was 3.1%. It's expected to come in at 3.1%. And once again, the core, and then you trim, okay, which is that you take the top 20% of the inflation rates and drop them out, and the bottom 20% and drop them out, and you have the remaining 60%, and then you calculate the rate based upon that. And previously it was 3%, it's expected to come in at 3.1%. I do want to say that the Bank of Canada actually looks much more closely at the core median and the core trim values than they do the headline CPI numbers. And here we are here because the value here is expected for the headline number to come in at 1.8%, target 2%, so slightly below. But these other values that the Bank of Canada actually looks at are still above 3%, and this is problematic. This week for earnings releases, we're seeing the earnings season really starting to wind down, but we are what I call an retail week. On Tuesday morning before the bell, we see Home Depot announce earnings. We do see Toll Brothers, so we'll get a look at the housing sector closely after the bell on Tuesday. On Wednesday, we see Target before the bell, TJX as well before the bell. Then we come down Boss as well before the bell. So we got a few retail companies actually reporting this week before the bell. We do see Walmart on Thursday morning. That's going to be an interesting one to see their comments on consumers' capability of spending in the future. Some of the comments in the past haven't been that strong, so we'll have to wait and see what they say. This week, the big market mover will probably be the Jackson Hole Economic Symposium taking place. Every year, mid to August to late August, the Federal Reserve gets together and has a retreat in Jackson Hole, Wyoming, and they talk about the policies of what's working and what's not working. It's a reflective time for them and what they could be changing in the future, etc. Powell has made speeches in the past from the Economic Symposium. He's expected to make that this week as well. It's going to be interesting to see what happens because there's a lot of pressure on Powell from a number of sources, not just Trump, but a lot of economists saying that Powell's behind the curve, should be cutting rates. We saw two Federal Reserve governors actually come out last month and say that, yes, they're in favor of a rate cut of 25 basis points. And now we actually have an appointee on the board, and I think that he will be in place to be able to vote at the next meeting, which would be September the 17th. So based upon him being a Trump pick and his comments in the past, he will also probably be largely in favor of a rate cut. Now, it's almost a foregone conclusion the rate cut's going to take place. If we take a look at the markets, the probability markets and the swaps, they have it, it's about 94% at this time that the Federal Reserve is going to cut their key interest rate by 25 basis points. When that happens, it's very seldom do you ever see the Federal Reserve actually not cut rates when the probability is that high. So what's going to happen this time around with Powell? I think he might actually, yes, I think concede a little bit and say, yes, we do need to start moving into some sort of looser monetary policy, or come back to that and start cutting rates here. And I think, if we take a look at what his position is going to be, I don't think he's going to concede a lot. I don't think he's going to come back and say, we need to actually start by cutting by 50 basis points. We need to really get down fast and there's real danger. I think he's going to come back to his tried and true, what he's been saying recently. The unemployment rate is still in the low 4% range. Inflation has not been beaten. And the big problem Powell has is that the U.S. government, this is not being political because they're all doing it, is spending huge amounts of money, which is inflationary. And so the situation where we're seeing inflation actually stabilize, looks like it might head higher, this is a very difficult situation. And I think Powell will give a little bit, but not a lot. And that could upset the market a little bit. If we take a look at the reaction in the S&P 500 to the economic symposiums that have taken place over the last 7 years, we can see here in 2024, we did see the market tick down lower before moving up. In 2023, we did see a slight tick higher, and then the S&P 500 headed lower. 2022, we did see the S&P 500 move lower. 2021, lower. 2020, lower. 2019, we did see actually move sideways here. And 2018, we did see it move higher before it started to correct at this point. I would say overall, over the last 7 years, we have seen the market react on the weaker side to the economic symposiums at that time. There are other factors obviously influencing the market at this time, but we haven't seen a big, huge driving force from the Federal Reserve announcing anything at the symposium that's driven the market substantially higher. This is going to be an interesting week. Once again, thank you for joining me. Please like the video and subscribe. Thank you very much.